Hey YouTubers, welcome back to the channel. In today's video, I thought it would be useful to talk about how to invest during a financial crisis. Essentially, being in a better position to invest smartly without having to run into fear and jump ship like the Titanic and leave Jack to freeze in the water. And we all know there was enough space for both of them. So in this video, we will cover 4 key things. How knowledge is key, how diversification can help from breaking all your eggs, how consistency equals cash, and how focus ensures you that you'll stick to your plan. And ultimately, I hope to get you into a better mindset to ride this corona wave financially. While the intro video plays, you might as well subscribe to the channel if you haven't already, and if you agree with me that there was more than enough space for 2 people on that floating door, then hit the like button. So, the big question, how should we invest during this financial crisis? Basically, plan ahead and be willing to ride out the storms. Well, that's pretty much the end of this video. See you later. Okay, but seriously, just like whenever you decide to go on a nice family summer holiday, you first do your research and prepare yourself for that holiday. You usually go and pack all the clothes that's needed according to the weather. Then, as you're accustomed to the UK weather, you'll probably throw in a jumper or a light coat, just in case. And then you plan out what are you going to do for the few days that you're out there. And as part of a great plan, you would also accommodate for everyone in the family, so that the wife is kept happy, and if you have kids, they're also happy. Now the same goes with investing. You need a good plan. Now the main question here is, how do I make that financial plan? This comes down to financial education. The most important thing we should learn, yet we are not even taught this at school. However, when we're younger, most of us actually have a very solid foundation, and that quickly gets tainted by trying to act like we have more money than we actually do by following our favorite celebrities. So, what is that solid foundation? Well, most of us were brought up with a piggy bank or a money box or some sort of method to save up our money. Now, we usually had aspirations for that money, whether it was to buy the latest football stickers, or the latest PlayStation game, or even the latest Jordans. And eventually, over a time period, we managed to achieve that goal. So the same applies now for investing, as we should always start with the why factor and ask ourselves, why do we want to invest? Do we want to build up a rainy day fund, make some money to go on holiday, or put aside some money for retirement, or possibly all of those things? Essentially, by identifying your reasons for investing, you can then help guide where you put your money and how you can make it work for you. For instance, to save up for a holiday or a rainy day fund, you will want that done quickly, but for retirement, you'll be looking at a long-term investment. You can then do the research required in order to identify how much money you need and when you want to make it by. Great! Now you know why you need to invest. Now the next step in the financial plan is to identify what do you need to do. If we go back to our piggy bank, we're usually given a set amount of money every week as an allowance for doing our chores, and we put that money straight into that piggy bank. And we knew exactly how many weeks it would take us to save up enough money before we can go out and buy those brand new Jordans. Well, guess what? That consistency is exactly what you need to do now. So when you decided why you wanted to invest, you would have also identified how much you wanted to invest and when you want to invest it by. So now, with some basic maths, you should know how much money to set aside each month. And the great thing about this is that in this day and age, we can automate it with standing orders to ensure that the fixed amount of money is being saved each month. It's really easy as well because most of us have got online banking, so we don't even have to go down to the bank. So the next question is, what should I invest in? Now, investments doesn't always mean making money. Sometimes you can invest in yourself in order to get into a better place. Therefore, one of the safest investments will be to put money towards any debt that you may have, be it credit cards or any loans you may have. Another safe haven is your pension plan. Now in the UK, we obviously have basic state pension, which automatically comes out of your pay. However, most companies offer a private pension plan. It is really important to know and understand what the terms are of your pension plan. Then you can make sure you are using it to the best of your ability to essentially get free money from your employer. If you don't know about your pension plan, best thing to do is reach out to your HR department. The other great safe haven are saving accounts and cash ISAs. With a cash ISA, you can save in a tax year up to £20,000, where you don't need to pay any tax on any interest or income and capital gains that you may get from your investments. Then we have the more riskier methods of investing, such as the stock market and bonds. You can also invest in these within a stocks and shares ISA account. And then there are also more costly options, such as real estate. Now, deciding what to invest in becomes a bit more trickier, as all investments incur a certain level of risk, which can be good risk, where our money goes up in value, or bad risk, where our money can lose value as well. If you're considering a short-term investment, the risk levels are a lot higher, as you could make some great short-term investments and manage to exit at the right time and receive huge gains. But at the same time, during a financial crisis like this, where there are so many unknowns, you can also end up losing a lot of money. We've just gone through a financial crash where the stock market value fell around 30%. Therefore, it can take a while for the markets to recover from such downturns. But luckily, we have history to guide us that the markets will always tend to recover, but usually this happens in cycles. This is why, when it comes to long-term investing, you should never react to the market and keep your mind stuck on the longer game, as during the course of time, your money will swing up and down. But if you zoom out and just look at the market trends over decades, you can see a steadier trend and eventually realize that in the long run, it is likely that you will be in a net positive. Deciding on what works best for you really depends on what kind of person you are. Warren Buffett, the granddad of investing, has said before that some people should not own stocks at all because they just get too upset with price fluctuations. Therefore, knowing your tolerance to risk will become vital in deciding what way to invest. Next in line for a financial plan is understanding diversification. Most of you would have heard of the well-known saying, don't keep all of your eggs in one basket. Just in case you don't know, the reason for that is because if you drop the basket, you're likely to lose all of your eggs. The reason I mention this is because we should think of our investments in the same way. Within stocks and bonds, there are different types of investments, such as different classes and sectors, where certain classes and sectors go up, others may go down. Therefore, it is usually a good idea to diversify your investments in different areas. But remember, diversification does not mean that you will guarantee a profit or eliminate the risk, but it does allow you to bring your risk levels down a little bit, especially if you have the right balance within the different areas. Now, the good news though is that you don't need to work this all out yourself, because there are pre-made packages such as funds and ETFs. If you want to know more about ETFs, check out my other video on index funds, and you can see a link, I think, around here. Now, there's obviously lots of information on the internet and lots of videos on YouTube about this, and it's always a great idea to get a financial advisor as well. Basically, there are a lot of options out there to help you decide, but make sure you've always done the necessary due diligence required before investing in anything. Now, the most relevant question right now is, what should I do if the market drops? Now, if you go back to your little piggy bank, let's say we had another 4 weeks before we could afford those Jordans. And now, say the market, the Jordans, drop in value. What should you do? You'd run out and go and buy them. The reason for this was because you had a plan. That plan was to save enough money to buy those Jordans. So within your detailed plan, if you felt like you wanted to invest in the stock market, now is a great time to invest, as a lot of stocks are at a bargain value. But it is also risky to buy things in an unknown market. because the key is to understand why the price has actually dropped. Maybe those Jordans dropped in price because there are new Jordans coming out, or maybe those Jordans have a defect in them. The exact same applies to the stock market. You need to make sure that you have done the necessary research on the company that you're planning to invest in, just in case if they're doing bad in this economy, because maybe they're a retail shop where we've seen many retailers go into administration. You could then end up losing out in your investment if that company then becomes bankrupt. However, if we look at some of the companies that we've looked at in market moments, like Berkshire Hathaway, that has a huge cash pile, there is a good chance that their shares can bounce back up after this turmoil. So, investing in the financial crisis comes back to the fact that knowledge is clearly the key. By taking the time to understand different factors that can affect the market and doing your own research, the more you know, the better position you will be in order to manage your portfolio. Now, diversification is definitely the best way to get through this crisis by making sure your money is safe, as well as taking certain risks that you feel comfortable with in order to get better results. And consistency of segregating a certain amount of money every month will no doubt help you with generating a cash pile. And then focus. Focus on the plan that you set out to achieve. And remember to regularly assess your strategy, because it is possible that your investing goals and risk tolerance could change over time. So, I hope that I've given you an insight of how to get your mindset ready in order to ride the corona wave financially and help you if you are thinking of investing in this financial crisis. If you've decided to take on board anything I've said, please leave a comment, as I'd love to know what you have found to be the most interesting. And as always, if you liked the video, or even if you didn't, remember to hit the subscribe button if you haven't already, because it's not like I'm sitting here every day waiting for my subscriber count to go up. But make sure you click the notification bell so you are notified when my next video comes out. And don't forget to like, share, and comment. See you at the next video. Bye.